Hello, everyone. Glad you're here. Today, we're going to walk through exactly how your Social Security benefits are taxed and how to properly report them when filing your taxes. This is information that every single Social Security recipient needs to understand because mistakes here can cost you money or trigger unwanted IRS notices. Before we dive in, I have a quick request. If you're watching this channel for Social Security news and updates, please take a moment to hit that subscribe button. I'm working hard to bring you the most important information affecting your benefits, but I need your help growing this community. Subscribing takes 2 seconds and helps more people find this critical information. So please, if you haven't already, subscribe right now and turn on notifications so you never miss an update. All right, let's get into this, because understanding how your Social Security benefits interact with your tax return is absolutely essential for every beneficiary. Here's something that surprises many people. Your Social Security benefits may or may not be taxable depending on your total income situation. This isn't a simple yes or no answer, and that's where the confusion starts. The IRS uses something called provisional income to determine how much of your Social Security benefit is subject to federal income tax. Depending on your provisional income and filing status, anywhere from 0% to 85% of your Social Security benefits could be taxable. Let me break down those thresholds for you, because these numbers matter. For single filers, heads of household, and qualifying surviving spouses, if your provisional income is below $25,000, your Social Security benefits are not taxable at all. If your provisional income falls between $25,000 and $34,000, up to 50% of your benefits may be taxable. And if your provisional income exceeds $34,000, up to 85% of your benefits could be taxable. For married couples filing jointly, the thresholds are different. If your combined provisional income is below $32,000, your benefits are not taxable. Between $32,000 and $44,000, up to 50% may be taxable. Above $44,000, up to 85% of your benefits could be taxable. These thresholds have not been adjusted for inflation since they were established decades ago, which means more and more Social Security recipients are finding their benefits taxable each year. This is sometimes called bracket creep, and it affects millions of beneficiaries. Now, let's talk about how provisional income is actually calculated, because this is where many people get confused. Provisional income is not the same as your adjusted gross income. It's a special calculation the IRS uses specifically for determining Social Security taxation. Here's the formula. Take your adjusted gross income, add any tax-exempt interest you received, and then add half of your Social Security benefits. That total is your provisional income. Notice that tax-exempt interest is included. Many people invest in municipal bonds thinking that income is completely tax-free, and while the interest itself isn't directly taxed, it does count toward your provisional income and can push more of your Social Security benefits into taxable territory. This catches a lot of retirees off guard. They think they're being tax smart by investing in municipal bonds, but those earnings are indirectly causing more of their Social Security to be taxed. Every January, Social Security beneficiaries receive a form called the SSA 1099. This is your official record of how much you received in Social Security benefits during the previous year. The SSA 1099 shows several important pieces of information. Box 3 shows the total benefits you received. Box 4 shows any benefits you repaid. Box 5 shows your net benefits, which is the number you'll use for tax purposes. If you had Medicare premiums deducted from your Social Security check, those deductions are already factored into the amounts shown. The net benefit in Box 5 is what you actually received. Keep this form with your tax documents because you'll need it when filing. If you don't receive your SSA 1099 by early February, you can request a replacement through your My Social Security account online or by calling Social Security directly. One important note for those who receive both Social Security retirement benefits and supplemental security income: SSI is not taxable and is reported on a different form. Only your Social Security benefits from the SSA 1099 are potentially subject to federal income tax. When you file your federal tax return using Form 1040, your Social Security benefits are reported in a specific section. Line 6A is where you enter your total Social Security benefits from Box 5 of your SSA 1099. Line 6B is where you enter the taxable portion of those benefits. The calculation for determining how much is taxable can be done using the worksheet in the Form 1040 instructions, or your tax software will calculate it automatically if you enter all your income correctly. Here's an example. Imagine Susan is a single filer who received $20,000 in Social Security benefits during the year. She also has a pension that pays her $18,000 annually and receives $2,000 in interest from her savings accounts. Her provisional income would be calculated as follows. Take her pension income of $18,000, add her interest income of $2,000, and add half of her Social Security benefits, which is $10,000. Her provisional income totals $30,000. Since $30,000 falls between $25,000 and $34,000 for a single filer, up to 50% of her Social Security benefits may be taxable. Using the IRS worksheet, she would calculate the exact taxable amount. Susan would enter $20,000 on line 6A of her Form 1040 and the calculated taxable amount on line 6B. Here's something many beneficiaries don't realize. You can have federal income taxes withheld directly from your Social Security payments. This can help you avoid a surprise tax bill or underpayment penalties at the end of the year. To set up withholding, you need to complete IRS Form W4-V and submit it to the Social Security Administration. You can choose to have 7%, 10%, 12%, or 22% of your monthly benefit withheld for federal taxes. There's no option for custom percentages. You must choose one of those 4 options. If none of those rates match your actual tax situation perfectly, you might need to make estimated tax payments to cover any difference. Many financial advisors recommend setting up withholding if you know your benefits will be taxable. It spreads your tax payment throughout the year instead of requiring one large payment in April. The amount withheld will be shown on your SSA 1099 at the end of the year, and you'll report it on your tax return just like any other federal tax withholding. If you don't have taxes withheld from your Social Security benefits, or if your withholding doesn't cover your entire tax liability, you may need to make quarterly estimated tax payments. Estimated payments are due 4 times per year. For tax year 2025, those dates are April 15th, June 15th, September 15th, and January 15th of the following year. The IRS generally expects you to pay at least 90% of your current year tax liability or 100% of your prior year liability through withholding and estimated payments. Failing to meet these thresholds can result in underpayment penalties. For retirees with multiple income sources like Social Security, pensions, investment income, and perhaps some part-time work, estimating your quarterly payments can be complex. Tax software or a tax professional can help you determine the right amount. Form 1040-ES provides worksheets for calculating estimated payments, and payments can be made online through IRS Direct Pay, by phone, or by mail. While we've been focusing on federal taxes, it's important to understand that state taxation of Social Security benefits varies dramatically depending on where you live. Currently, most states do not tax Social Security benefits at all. However, there are still some states that do tax Social Security income to varying degrees. The states that tax Social Security benefits have different rules about exemptions and thresholds. Some provide full exemptions for beneficiaries below certain income levels. Others offer partial exemptions, and the rules change frequently as states update their tax codes. If you live in a state that taxes Social Security, you'll need to report your benefits on your state return according to that state's specific rules. This is separate from your federal return. For retirees considering relocation, state tax treatment of Social Security income is definitely something to factor into your decision. Moving from a state that taxes your benefits to one that doesn't could result in meaningful tax savings. Let me walk you through some of the most common mistakes I see Social Security beneficiaries make when filing their taxes. Mistake number 1 is assuming Social Security is never taxable. As we discussed, depending on your total income, up to 85% of your benefits could be subject to federal income tax. Never assume your benefits are tax-free without doing the calculation. Mistake number 2 is forgetting about tax-exempt interest. Remember, even though municipal bond interest isn't directly taxed, it counts toward your provisional income and can make more of your Social Security taxable. Mistake number 3 is not setting up withholding or estimated payments. Many retirees are shocked when they file their return and discover they owe thousands of dollars. Planning ahead with withholding or quarterly payments prevents this surprise. Mistake number 4 is entering the wrong amount from your SSA 1099. Make sure you're using the net benefit amount from Box 5, not the gross amount from Box 3. If you had any benefits repaid during the year, this difference matters. Mistake number 5 is missing deductions that could lower your provisional income. Contributions to deductible retirement accounts, health savings accounts, and certain other adjustments can reduce your adjusted gross income, which in turn affects how much of your Social Security is taxable. Now let's talk about some legitimate strategies that can help reduce the tax burden on your Social Security benefits. Strategy 1 involves timing your retirement account withdrawals carefully. Since traditional IRA and 401k withdrawals count toward your provisional income, taking larger withdrawals in some years and smaller withdrawals in others can help you manage how much of your Social Security is taxed each year. Strategy 2 is considering Roth conversions before you start Social Security. Roth IRA withdrawals don't count toward provisional income. Converting traditional retirement funds to Roth accounts before you claim Social Security means future withdrawals won't push your benefits into taxable territory. Strategy 3 involves being strategic about when you claim Social Security. Delaying your benefits not only increases your monthly payment, but also gives you more years to do Roth conversions or draw down traditional retirement accounts while in a lower tax bracket. Strategy 4 is coordinating with your spouse. For married couples, the combination of both spouses' incomes and benefits determines taxation. Sometimes having one spouse delay benefits while the other claims early can result in a better overall tax situation. These strategies can be complex and depend heavily on your individual circumstances. Working with a financial advisor or tax professional who understands Social Security taxation can help you develop the best approach for your situation. For tax year 2025, the filing deadline is April 15, 2026. This is when your return must be filed or an extension requested. If you need more time to file, you can request an automatic 6-month extension using Form 4868. However, it's critical to understand that an extension to file is not an extension to pay. If you owe taxes, you're still required to pay by the original April deadline to avoid interest and penalties. For Social Security recipients who are owed a refund, there's generally no penalty for filing late. However, you only have 3 years from the original due date to claim a refund. After that, the money is forfeited. If you're receiving Social Security and have a simple tax situation, filing early has advantages. Refunds are processed faster early in the filing season, and you reduce the risk of tax identity theft, where someone files a fraudulent return using your information. And that covers the essential information every Social Security recipient needs to know about how their benefits are taxed and reported.
Remember, everyone's tax situation is different. The examples we went through today represent common scenarios, but your circumstances may require additional forms, schedules, or professional guidance.
If you found this information helpful, please subscribe to this channel for more Social Security news and updates. I cover benefit changes, policy updates, and strategies you need to know about throughout the year. Every subscription helps this channel grow and reach more people who need this information. Also, if you have topics you'd like me to cover in future videos, leave a comment below. I read all the comments and use your feedback to create content that helps this community.
Thanks for watching. Take care of yourselves, and I'll see you in the next video.